Hi, students. We will start Chapter 13, dealing with liabilities and contingencies now. Um, Liabilities are one of the ways businesses are financed, especially when a business is starting. The owners usually contribute some capital, some owner's equity, and then they usually borrow some money, incur liabilities. So most liabilities obligate the debtor to pay cash, but that's not always the case. Sometimes a liability, for example, customer making an advance payment on some customized item they want you to manufacture, may require you to sacrifice those goods you manufacture in the future. So let's think about our definition of a liability. We talked about this before. Remember, three parts to the definition involving past, present, and future. Now, what is a liability? Well, it's a present obligation arising from a past event or transaction, and it will require a probable future sacrifice. That's the three elements. So, past, present, future. Now, the future sacrifice, notice a probable future sacrifice, that's going to come into play later. But what does probable mean? Well, it means highly likely to occur. So if the incurring of a future sacrifice is not highly likely to occur, we don't recognize a liability. Now let's move on down. So current liability, and during financial you probably learned of current liability is a liability that comes due within 1 year or one operating cycle, whichever is longer. I like the way they say it down here. A more discriminating definition identifies current liabilities as those expected to be satisfied with current assets or by the creation of other current liabilities. That's really more important than when it comes due. Okay, we can classify liabilities as either current or long-term. This statement right here, conceptually, liabilities should be recorded at their present values. And for long-term liabilities, we do that. For current liabilities, the idea is they're usually due so soon that the interest is unimportant and immaterial. And so current liabilities are almost recorded at their maturity value. Okay, let's move on down. They talk about accounts payable and trade notes payable. Those arise in the normal operation of business. Their accounts payable are from your suppliers, supplying you goods, inventory, other goods. Commonly, it's an account payable. An account payable is usually only documented with an invoice, you see right here. Notes payable are documented with a formal note. Notes payable usually require the payment of interest, while accounts payable usually don't. Let's move on down. Short-term notes payable. You sign a note, they bear interest, but they are short-term, usually less than a year. Your book talks a little bit about credit lines here. Commonly, small businesses have credit lines. Oftentimes, people have credit lines. Credit line is just a situation where you have gone to a lender, usually a bank, and filled out all the paperwork to take out a loan, but you don't get the money immediately. Instead, what you get is a line of credit where you can borrow that money anytime you want. Quite commonly, you get checks you can write, or you can just go online into your bank and transfer money from your credit line into your bank accounts. Now, usually there's a fee for maintaining the credit line, commonly about 1% of the loan, which when interest rates were 10% or around there, 1% was no big deal. You had a $50,000 credit line, you paid $500 a year just to have that credit line. With interest rates down around 3 or 4%, now all of a sudden that 1% fee seems a lot bigger. The credit line, you only pay interest on the amount you have actually borrowed. So if you have a $50,000 credit line and you've only borrowed $20,000 from it, you're paying interest on the $20,000. You still have $30,000 available. Talk a little bit about sometimes banks, rather than requiring a fee, require a compensating balance of, say, 5% of the credit line. We've talked about that before. That 5% then becomes restricted cash and not treated as just cash on the balance sheet. It becomes restricted cash, and if it's a long-term commitment, it may be a non-current asset. We talked about that back in Chapter 7. Interest, I think you all know how to calculate interest. We've talked about it before. Face amount, or the amount borrowed, times the annual interest rate, times the amount of time involved for the period we're calculating interest. Now remember, the interest rate and the time have to be expressed in the same time units. They move down here and calculate and show you journal entries. Here you borrow money. So debit cash, credit notes payable. There you are paying back the loan and the interest. So we debit interest expense for the amount of interest. We debit notes payable for the face amount of the note, credit cash for the amount paid. They talk about, and I like this, so-called non-interest bearing notes. So-called because commonly they do carry interest. It's just discounted in the amount that you get whenever you sign the loan and get the money. So your book discusses non-interest bearing loans. You have to then amortize the discount on the note to calculate interest expense, and the amortization, if it's a long-term note, is on the effective interest method. We've talked about that before. Now here you see an example of a non-interest bearing note. So you bought inventory for worth $658,000. You signed a $700,000 note. So the difference of $42,000 is a discount on the note. The discount effectively becomes interest. So here, 6 months later, you pay off the note. You debit interest expense, credit the discount for the amount of the discount, and then debit notes payable, credit cash for the $700,000 paid. When interest is discounted from the face amount of the note, the effective interest rate is higher than the stated interest rate. And they show you how to calculate that. You calculate the amount of interest and then the amount of money you actually borrowed. So up here, even though we signed a $700,000 note, we only borrowed $658,000. The other $42,000 is interest. So the stated interest rate was 12%. But what's the effective interest rate? Well, we divide, get 6.38. That was how much the interest rate for 6 months. Then we have to double that to get to the effective interest rate. Okay, secured loans. Secured loans, we are putting up collateral, something like you buy a car or you buy a house. That's a secured loan. You're putting up the asset as collateral for the loan. And notice footnote 7 down here. I pointed out up here what it relates to. And be sure to understand that we are actually recording the note at $658,000, not $700,000, but are recording the interest portion separately in a contra liability account, discount on notes payable. The entries shown reflect the gross method, but the net method, the interest component is netted against the face amount of the note as follows. The net method is almost never used, but there you don't show the discount, you just show the note at the amount borrowed, and then you amortize the interest over its life if it's longer than a year or carries past a year end. But wanted you to understand, make sure you understand that we're really showing the note payable at $700,000, but the net book value is the net of the note and the discount. Talk about commercial paper. That is just borrowing from a corporation. They issue commercial paper, essentially issuing a note to borrow money. Common minimum denominations are $25,000. And the maximum length of time it can be for is 270 days or approximately 9 months. And the reason for that is if it goes beyond 9 months, then they have to file a registration with the SEC, which becomes a lot more paperwork and a lot more expensive. Now they all of a sudden have to get auditors involved. And so commercial paper is just short-term borrowings from anyone who's willing to buy that. In times when the market is very uncertain, a lot of investors will go and start looking for something that's less risk. Okay, in the statement of cash flows, any borrowings are considered financing activities. Remember, financing activities are activities involving transactions with lenders and with owners. So if we borrow money, that's a financing activity. If we pay the money back, that's a financing activity. If we pay interest, that's an operating activity because it affects net income. So you see now we have some homework, but I only have about 2 minutes left in the video, so don't have a lot of time to go over homework. I will cover homework in the next video, but let me just go ahead and talk about accrued liabilities. You should remember those from financial accounting. We accrue liabilities for obligations that we have incurred but have not yet paid at the end of an accounting period. So what do we accrue? Things like interest, wages, utilities, all good examples of things, taxes, where we have incurred an expense but not paid it, not recorded it. So when we get to the end of the period, we have to make adjusting entries to record those accrued liabilities. So what do? Well, we debit an expense. So let's say it's wages. We debit wages expense or wages and salaries or something like that expense. Credit wages and salaries payable. So that it's getting a good spot to stop, so I will stop there. The next video I'll start with these homework problems. I also want to work through some effective interest problems, amortization problems as well.